Hello, everybody. Kirk Spano. It is retirement income options expiration update today, and I have a lot of things that I want to go through. If you've been following in the chat room, which you should, I have said that we probably get a rebound rally here in the very short term. So let's adjust to that in the context of, I think this year is really shaping up to be a lot like 2018, and we have a roadmap for that. By the way, I'm wearing a collared shirt, and I have shaved to remind myself that it is Monday, and to get out of the whole playing poker and watching NCAA basketball thing from over the weekend. I hope everybody's team is doing well. I picked the Badgers, the Wisconsin Badgers, and the Marquette Golden Eagles to get to the Final Four every year, and I'm usually disappointed. I haven't done a bracket in 3 or 4 years, though. So, I get to just watch the basketball to see if there's a good game. I tell you what, Arkansas, holy cow, and New Mexico, really some pretty good games that have been going on out there. It was interesting to see the reaction from Coach Hurley when Connecticut lost. Really, it's been a fun tournament to watch. I actually have watched more this year than I have for, I bet 6 or 7 years. I've had the TV on for 4 days now. I'm glad that they don't play Monday, Tuesday, Wednesday. It gives me a break. I'm just getting a lot of work done suddenly because Jolene's out of town for a couple of days. Yeah, gonna get through a lot of things. Now, so retirement income options. Remember, you can always go to resources and margin of safety, and the most recent option expiration update should be linked in here. It's not because it didn't take, but I will update that. So you can also go to analysis. Just put in the word that you think will come up. If you put in update, the keyword, it should be pretty easy to find, the option expiration update for February. And I want to go through this with you today. We will get to it, though, in just a minute, because I want to show you what's been going on X. Now, I know a lot of you quit X. I get it. I use it because there really are still a lot of good people on there. And I've been changing all my profile settings to really just kind of filter out the political stuff. So when you get something in your feed and it's political and you just don't want to deal with it, you just got to put not interested. And over time, the algorithm treats you a little bit better. The more important thing to do is you go to your settings in here and you change all your settings. And there's like 5 spots where they track you. You got to turn off all the tracking. I'm going to show you some charts today. So I follow the short bear. He's about a 30-year-old, it sounds like, who was trading, and now he's doing something a little bit different. And he points out that the CTAs were net short as of Friday. And that is usually a pretty good indicator that you're going to get a rebound rally. And we're seeing that today. Other people have also highlighted this. If I can find it for you. Is it right there? Yeah. So this one's from Goldman Sachs. CTAs are net short, and then you got a big rally. Now, I think this is not going to get way up here again. I think it's going to get in here. The timing aspect of this is that for the next 2 to 4 weeks, the market is probably net up. Now, here's the thing. It has to be able to hold a 3.5% gain historically. Again, I have said over and over again that the data sets on the stock market are not great. So all these people that show you a correlation, unless there's a really deep data set, which there usually is not, they're hard to put a lot of faith in, but you should at least be aware of it, because a lot of times, I'd say probably 4 out of 5, the correlations do tend to either hold up or come close. So this should bounce into here, I think. I think these right here and right here are the ones that I'm eyeballing, but these are pretty good too. I just don't see a 2-year rally developing right now. So I think we are going to get just 2 to 4 weeks, a massive unwind. I think the stock market goes up for the next 2 to 4 weeks, and that's an opportunity to sell covered calls. If you want to sell April and May cash secured puts right now or tomorrow, I have a few trades for you, and we're going to talk about a couple of those companies. There are certain stocks that are so cheap that you just buy them. if you like the story enough. And I am still in the camp of stick with your 20 best ideas, ignore the rest. The overall liquidity of the market is not getting better. And I really just see a couple of pumps of liquidity coming. I think the unwind of the short positions right now will be a 2 to 4 week thing. That's typically what it is. When they get the reconciliation bill done in May, it sounds like they will raise the debt ceiling, and that will allow the Treasury, which is holding a bunch of cash right now, to try to finesse its way through avoiding a technical default, to unload some of the cash that they're holding. So there'll probably be another pump of cash that lasts maybe a month or two when the Treasury unwinds. So this April, May, June, maybe into July period, I think you could get a choppy market with an upward bias. So I'm looking for a spot this week. Hopefully the market sells down at the end of the day. I want to just close my put positions temporarily and look for a better spot. I'm going to end up being about even on them. That's fine. They kept me market neutral while I wanted to be market neutral. And I think that it's very difficult to be a short. So don't mess around with it. You can't set it and forget it. You got to manage it and understand what your purpose is. As I've told you, I wasn't speculating on the downside. I was just having a hedge against my long positions. So I want to close that because it did its job. And I want to figure out a way to really primarily be long within those trends that we see as being a big deal. One of the trends, I think, and I said this earlier in the year a few times, I think energy might be the trade of the year. I'm not positive. I think there's a lot of uncertainty. Jerome Powell said that 11 times last week in his meeting, uncertainty, uncertainty, uncertainty. And I think that that's important. Mark Cuban today talked about how the tariffs are being laid out according to Howard Lutnick and the administration, and that they think that they can raise enough money on tariffs to lower income taxes. And Cuban pointed out that people who don't earn much more than the standard deduction all get hurt by tariffs going up, right? Because they're not really paying income taxes. So the tariffs end up being extra, expense. They're inflationary for them. Now, I pointed out in my reply to him, which we might be able to find. Yeah, there you go. The reality is that people with effective tax rates that are below the tariff rate are hurt, right? That's extra expense for you on goods that you buy that were imported because there's a tariff that the companies, but mainly the consumers, are paying. Let's take a look at how income distribution works out in the United States. A person earning $100,000 a year has an effective tax rate of about 15%. Now, I used 100,000 because it's a number, it's a round number that people kind of equate with success, right? Well, for them, tariffs above 15% will then hurt. Okay, well, but how many people really earn under $100,000 a year? That's about 82, 83% of the population. So tariffs are an inflationary impact on probably around 80% of the population. So I think these tariffs will certainly be in that 15, 20, 25% range when all is said and done. So if you are in the top 20% income wise, if you're earning 6 figures or 7 figures, especially if you're earning 7 figures, getting rid of income taxes or doing income tax breaks really helps. For 80% of the population, tariffs are inflationary and you're really not getting an income tax break. I don't see this working out well if they really impose tariffs that raise the cost of living for 80% of the population. I just don't think people have thought that through, and I think that the impact is going to be rather severe. I've been talking about how the U.S. Treasury market is having a problem. We have that $6 trillion to refinance this year, and it was either Gundlach or Druckenmiller. I can't remember which one. I think it was Druckenmiller. Said that he expects a recession to be not a low interest rate event. What he expects is that the recession is caused because interest rates go up, and that is why Scott Bessent is trying to figure out a way to get the 10-year treasury rate down. And he's having a hard time, right? It's been jitterbugging within a quarter point of that 4.5% range. And if the bond market can't handle all the debt coming due in the next 4 or 5 years, and then goes into the period where the boomers are at max retirement, we really could have a rather long-term malaise. And I think that indexers are the ones that are going to get really hit. So all these, and I'm writing an article about that, all these folks who index either on purpose or just by proxy of owning 6 or 7 mutual funds or ETFs, I think they're in trouble. I think that liquidity is going to be strained for a while. I think that the cost of living is going to go up on a lot of people. If you're not in the top 20% income, if you're not earning 6 figures, it's going to be very, very difficult for you in America, maybe for the next decade. And I don't really see that they are improving that situation very much. I don't think the tariffs are the way to go. And I know people say, but that means the jobs will come back. That's not what it means. The reality is that there's much, much better ways to increase manufacturing and the industrial base here. And honestly, the reason why we live so well, and I've talked about this before, and people need to wrap their head around it, is having a stronger dollar is good for really everybody in the country, but it's especially good for that 80% who are trying to buy things to live. So we're at full employment, and they're trying to get rid of immigrants that really have helped grow the economy. I have a hard time seeing how shrinking the workforce and shrinking the disposable income of 80% of the people is going to work out well. I really think that we have a major problem in the debt market. I think that it is coming way faster than I thought. And if you remember, if you've been with me a while, we talked about this during COVID and shortly after. And I said that the earliest estimate I saw for a debt crisis was 2026 all the way out to 2030. So that 2026 to 2030 range has always been the period where we really have to figure it out on the debt. And I know that they talk about the debt, but at the same time, they want to slash income taxes. We already know that we're not collecting enough to balance the budget. The 333 plan of the Trump administration, which is what the Trump administration is trying to do, and that Bessent, the Secretary of Treasury, talks about, is get 3% real GDP growth, hard to do if government spending is shrinking, reduce the budget deficit by 3%, hard to do if you're cutting taxes, and increase energy production by equivalent of 3 million barrels per day of oil. The energy guys are saying it's just not possible. So how do we get closer to a balanced budget if none of these things can actually be achieved? Now, I think the 3% real GDP at some point happens, but I don't know if it happens after a couple of 0 years, right? In which case, if you get a couple of 3s after a couple of 0s, you're still averaging out to between a 1 and 2. So I'm having a very hard time with this. I've been watching. I've been skeptical. I don't want to be right. I don't want to be right about this. We're going to have a hard time here. And this debt problem that we have, there's a way to fix it, and it's actually not even that hard, and they're not doing it. That the rhetoric that they're throwing out there that people are buying into, it doesn't math, right? The math doesn't math. And while you can like the idea, you can like the ideology, you can like the rhetoric, whatever, you can like the message, you can like the narrative. If you do the math, it doesn't work. And that's going to be a problem at some point. I don't know how fast. I think that we are getting this last puff on the cigar, last couple little puffs on the cigar. I don't know what happens come summertime. I really think that this debt is going to be a massive problem. I think you're going to see interest rates tick up. Foreign direct investment is falling, not rising. Foreigners buying U.S. stocks. I mean, there's just really a lot of ill will out there. We either have to print money, or we need a lot of foreign direct investment, or some combination thereof. I don't see either thing happening this year. So go back to sell the rips. I mean, that is my best message is sell the rips. You just don't want to be in S&P 500 correlated investments. You want to stick with your best ideas. You want to sell cash secured puts when things are drifting down. And you want to sell covered calls when you think that momentum to the upside is ending. And right now, momentum to the upside just started, right? Again, I think this is a 2 to 4 week rally. I think we get some angst going into the reconciliation process. I think that they finally get that done in May, and then you get the Treasury unloading their holdback money for keeping us out of technical default. That goes into the market for a month or two. And then after that, man, I don't know, man. By the second or third or fourth week, by the second half of July, I'm worried. So you need to use these next few months to get into the position you want to be in. And I know that there's a handful of people who sold everything. I just want 100% cash. And I guess that's okay. But if you're 100% cash, at least sell a whole bunch of cash secured puts on your best ideas. Generate some real income. All right. What have we covered? Oh, going back to that 333, right? If the economy has a 0 year, which kind of is shaping up to be a zero growth year, that means that there's less money being earned, less money being made. It leads to less of a wealth effect. So it means less velocity of money. What's going on in the markets is largely a game, has been gamified. It's gambling. And I don't think that most people can do the math. I don't think they try to do the math. And ultimately, when they lose 20 or 30% of their portfolio fast, or 50% because they try to catch falling knives, they're going to point. It was their fault. Well, I guess it's 40 years of, or 45 years of not managing the economy particularly well in most administrations. There's been some average administrations. There's been one good administration. And really, Clinton's the only guy that managed things well. Everybody else has been either bad or mediocre. So, you take a look at this and you just start thinking, oh, well, they shrink the economy by shrinking the labor force, by shrinking government spending. Foreign direct investment is falling off because everybody's pissed off at us. It actually makes me concerned about my trip to France next year. There's been a handful of people who have talked about a potential depression. I think the inherent strengths of the U.S. economy keep us from a depression, but I could see us in and out of shallow, maybe 1 or 2 deep recessions over the next decade, given the path that we're on. Eventually, I think government has to face this. And I think the only thing that they can do is back off on the tariff war. That might not happen for 4 years. And they need to print a lot of money. They need to do a lot of quantitative easing. I have floated the number of $15 trillion of potential quantitative easing by the end of this administration, and maybe another 15 or 20 trillion early in the next decade. So I think that there's a good chance that we have to see $30 trillion of quantitative easing over the next, say, 5 to 10 years. And people are like, oh my God, that's horrible. Yeah, it is. It's basically, we're going to pay our bills through inflation. And that is a conversation that's been going back for 15, 20 years. And I think that's what they're going to do. The problem this time is that all of that quantitative easing may not just jack the stock market up, because the government needs so much of that money to get close to get to a good debt position that the crowding out effect, that Econ 102 thing that I've talked about a few things, the government just soaks up too much of the money, and we don't get the mega rally that we saw after COVID. I'm having a hard time mathing out a broad mega rally in the large cap stocks. I think that for the next decade, we see a situation like similar to the 1970s. Kind of a light version. We're not going to get horrible stagflation, but we're going to get whiffs of stagflation. And in this environment, the small and the mid caps are absolutely the place to be. You need to find truly transformative companies, and you don't need 50 of them. You need 20 of them. You need to find companies that are truly growing their earnings, that have a margin of safety that is a combination of competitive advantage and a good price point, right? You can't buy things with 100 forward price to earnings ratio. What you really need to find are companies that are on the verge of profitability and on the verge of big profitability. And you have to be able to project out several years. And in the current moment, the narratives will be, but they're not profitable. I get tired of hearing that because the profitable companies have efficient pricing or expensive pricing. So either they're fairly valued or they're expensive. If you can find a big company, I think Google is one of them, to buy because there is unrecognized growth that doesn't reflect in the share price, I think that you can do that. So like Google, Alphabet is a company that on a 5 or 10% further correction, or preferably 20 or 30% correction, I would buy them. If I could buy them at 2022 prices again, I would. I think we're going to get a chance at a lot of 2022 prices. We might get 2020 prices, 2018 and 2019 prices. I don't know yet. So just understand that the whole set it and forget it, the whole doing things the way that you've done them during this quantitative easing, when we had space in the debt to jack the markets up like we have since 2009, it's coming to an end, because the next round of quantitative easing is not going to behave like the last round of last 5, 6, 7 rounds of quantitative easing. This one is going to be designed to make sure that we can pay our bills at all. And it's going to come in 2 or 3 waves from what I can tell. So just understand that this is not going to be an easy decade. And the cash secured put and covered call, the option selling tool, if you haven't bought into that yet, make it your mission in life this month to learn it, to crash course it, to study it, to read the things in the resources section, right? Read these. See if my links ever come up. They'll come up eventually. Learn covered calls and cash secured puts, because the speculators are going to overpay you. This is an inefficiency in the market. Markets are about exploiting inefficiencies. The next thing the market is about is building up your bullish positions, pyramiding up. Pyramiding up is something that Soros, Druckenmiller, a number of the other great investors talk about. And I try to talk to you about that. Everybody wants to just buy all the way down. No. If there's downward momentum, pause, stop buying. You have to let downward momentum dissipate. So Rocket Lab was up around $30 a share and it got down to 27 and 24. Should I buy it? Should I buy it? Should I buy it? Right? Wait, it's still going down. Now, Rocket Lab has chopped along now in the $16, $17, $18 range. I think selling cash secured puts is a pretty nifty idea. And even though it probably has a bottom fishing price around 12, 13, 14, 15, you're much closer to that now at 16, 17, 18 than you were at 30 and 27 and 24, right? So you have some margin of safety because, I'm either roughly at the bottom or the bottom's not too far down anymore. So selling those cash secured puts is a pretty good idea. AST Space Mobile, same thing. It was in the 30s and got down to 30. Should I buy it? 27. Should I buy it? 24. Should I buy it? Well, when it got under 25, I told folks, you probably sell cash secured puts here. Now, I had to sell some cash secured puts a little higher because I was hedging some covered calls. And now those covered calls have expired, which we'll cover in a second. So I am in the position of taking a look at my best ideas and deciding how much of them do I want. And I think for the next 3-4 months, I want lots of it, because if they rally real hard, right, I can write covered calls, suck out some profit, and then wait out the 6 months, wait out the second half of the year, which I'm telling you, it just really looks like 2018. I can't figure out a way that this doesn't turn into 2018. I don't know if we get down to those prices, but I think the shape of the years is going to be pretty similar. AST Space Mobile. They have 17 satellites under construction right now. They have rocket launch contracts with 3 companies, India, I forget what their company is called, and then Blue Origin and SpaceX. The Blue Origin rockets can take 6 to 8 satellites at a time. SpaceX can take 3 or 4, and ISRO out of India can take 1 at a time. Now, the India contract to me is very exciting. What does that mean? That means you're going to have access to the India market. So that opens up another billion people plus for the potential for AST Space Mobile. when you do the comps on AST Space Mobile, you just keep coming up with American Tower. And American Tower has been hovering around $100 billion market cap, and it's just kind of a stodgy dividend payer at this time, right? But if you take a look at the chart of American Tower, I think that what you end up seeing is the path the AST Space Mobile can take, right? Let's go back a decade. Let's erase some of the stuff, make life a little easier to look at. This is a pretty good chart, isn't it? From under $40 a share to 200. I think the AST Space Mobile is going to condense this timeline to about 5 years. And I think AST Space Mobile is going to go from, whatever it is, $8 or $9 in market cap right now. Yeah, 8.8 billion in market cap. I think it gets to a market cap of between 50 and $100 billion, I think by the end of the decade, give or take. They are going to have so many satellites up in the next 2 years. They're going to be over 60 satellites up by the end of next year. They might get to 90 by the end of next year, but I think 90 is in 2027. And they're probably up to around 200 satellites by the end of the decade. They are producing 4 to 6 satellites a month. They say 6. Let's give them some leeway. Or let's just say a couple months a year they're retooling and checking things out. They're going to be able to put up 60 satellites a year, give or take, until they get a total constellation of a little north of 200. Here's the thing. The first 60 satellites cover 2 to 3 billion people. And what they are doing is they're deploying the satellites essentially close to the equator, which is where most people live. So if you break the globe up into quadrants, your south and north quadrants, and then your middle 2 quadrants, basically everybody lives in those middle 2 quadrants. It's like 80-something% of the population. So those first 60 satellites bring pretty good coverage to most people. The next 60 satellites offer redundancy and more data. So suddenly you can do more things, right? There's no data cap. The first 60 satellites, you're going to have a bit of a data cap, unless you pay for an enterprise contract. But for the $10 or $20 a month that you might pay for AST Space Mobile in the months that you need it, or for intermittent service, you're not going to be able to stream a Netflix movie, right? Or anything like that. But you can do basics of the internet, like commerce. And once they add the deeper data a couple of years out, 2-3 years out, now it becomes, I think it becomes the go-to for coverage on most of the planet where it's hard to build cell phone towers. So I think cell phone towers end up being pretty much only along major highways and in cities. Well, what, 3/4 out of 3/4 of the world is not on a major highway or in a city. And I think that the population is going to spread out again. We have seen a trend in suburbanization in America pick up again. So there was this pullback to the city, and now all of a sudden back out to the suburbs. I think that the rural areas are going to continue to get populated. I think that there's a reversal in population growth from, so in the United States, it's going to be from the hot places and the places that burn and places that have hurricanes up to the middle parts of the country. You know that I'm a Great Lakes real estate investor, trying to be. For AST Space Mobile, a less centralized population in cities is good. And even if they only serve the 20% most affluent people, because those are the ones that can afford to have some acreage, it's a pretty good market to serve, right? Think about how Apple started. So I see AST Space Mobile pretty easily in that 50 to 100 billion range. We have, I'm going to call him a Philadelphia lawyer. I don't even know if that's where he practiced. Maybe he can say. One of our investors, pretty astute guy, did an analysis on AST Space Mobile, and he's coming up with some pretty big numbers. He thinks $150 a share is pretty viable, and that's a 5x from here. He says outside of Philadelphia. Well, I'm going to call you a Philadelphia lawyer anyway. That's what I always tell people. I say, I got this Philadelphia lawyer. And $150 a share, so you 5 times the current price, basically. Now you're at really close to a $50 billion market cap company. That's what 50 billion, that's what a 5x looks like, right? 50 billion is the bottom of my range. I actually think I actually think the AST Space Mobile, I think that if they get a FOMO rally, it could speed all the way to $300 a share. Now, remember, we bought this under $5. At 50, it's a 10 bagger for us. It's already over halfway there. And with option premium, it's even closer because I'm sure that quite a few of you like me have collected a lot of option premium. So this is the sort of stuff that's in our chat rooms. It's 29 pages. All right, so this will get posted over to Fundamental Trends too. I'll steal that over. So let's just take a look at what happened here in the last month. A bunch of my cash secured puts expired. So I actually closed these for about even. End phase is still out there for a few people. Where's the Marches? Here you go. The MP Materials expired. The New Fortress Energy just barely expired. Those almost got put to me. I had some other ones out there. Still have the April 15th. New Fortress Energy. I really like this company. And they've been rallying off the bottom. I think they're up to 11 or 12 now. I ended up selling some of these. I had a bunch of covered calls expire. So I actually ended up writing 4 March covered calls. They all expired. So these are the ones that were mentioned last month. And then some of the targets ended up getting sold. So I'll update this. I'm going to clean it up a little bit to get rid of some of the old data. I think that the options that you want to take a look at, I don't think you're writing covered calls right now. All right, you got to let this market rally. But the cash secured puts, I think you can take a look at Rocket Lab. Rocket Lab's up a lot today. But I think the May puts, if you get a couple down days, if you take a look at the $18 puts, you get $1.38. If you can get $2 for these on a dip, I think that the May $18 cash secured puts for Rocket Labs are worthwhile. For Rocket Lab is worthwhile. If you're jonesing, if you missed your dip last week, you could take less, right? It depends on what your positioning is. If you're cold coffee, must be from yesterday. I look for the dips, but Rocket Lab could rally to 30 here in the next month. So again, decide if you're trying to be perfect or just really good or trying to be excellent. And this is why I tell folks, you got to use limit orders, right? Don't wait for me to say, hey, I did this, because I'm doing it for my clients and for myself. And then I tell you, but I tell you ahead of time what I'm thinking. So if you put in your orders ahead of time and just let the market's volatility hit you, then you can put in that $2 price on the 18. And if it happens to get put to you, it's at 16, which we know is close to the bottom. So I would be entering orders for the May $18 cash secured puts on Rocket Lab, put in 2, and just hope the volatility of the market hits you. If you're just like, I got to have some of it, then do some of it at the market and then put in another order for more, right? Just don't soak up all your available capital. Rocket Lab is one of my top picks, though. So I can't see this company not being worth $50 to $100 billion either by the end of the decade. Remember the Elon Musk fatigue. This is an Elon Musk fatigue stock, as is AST Space Mobile, as is Ford. There's a lot of stocks out there that are going to benefit from Elon Musk fatigue, especially because I'm not so sure foreign governments and foreign investors are going to touch anything Elon Musk for a long time, if ever again. Take a look at AST Space Mobile. Again, both of these stocks bottomed out, it looks like, last week. So it's all the way back up to 28. I think you can sell $25 cash secured puts, take the $3, the 337. I think that that's a pretty good move. If you buy it back at around $1 or 50 cents, I think that that's worthwhile. I think that this stock can run into the middle 30s in the next month or two. Really, I think by the middle of April. I really think we're going to get a face-ripping rally here that you need to sell into somehow. And selling a cash secured put now, then having the market goes up, right? The value of that put will drop. You can buy it back or let it expire. So that's how you have to manage that. All right. If you have any questions, put them in the Q&A box, not in the chat. And I will either answer them now, or I will answer them in an article. I do think that the Invesco Solar ETF is super interesting to me. You can sell the May 30 and get $1. That's not super sexy. I mean, it's 3% for 2 months. Okay, there's 6 2-month periods in the year, so 6 times 3%, 18% annualized return. That's actually a little lower than I look for. I look for 25%. But what you could do is you could put in an order for $2 and just hope the volatility hits you. And in which case, now you're getting an annualized return of 36%, give or take, and that's better than 18%, right? So I think that is something that you can do. I think that it's a pretty slick move. So I would be looking to do that if I were you. So I will put in some of these orders that I'm going to try to have the volatility hit me in the new option expiration update, which I will do today. And then we can, work on it throughout the month, see if this rally plays out as the shorts unwind and as the FOMO, people try to take that last puff. Again, if you haven't been paying attention, the millennials are trading and they will switch directions quickly when they switch directions. So just can't expect this to be straight up. Oh, by the way, I have somehow influenced a number of influencers to really get on the Rocket Lab and AST Space Mobile bandwagons. I sure hope you guys have positions in AST Space Mobile, because that ride up might be, it's going to be choppy. It's going to be turbulent, but I think we get to 50 billion a lot faster than people think. I think we have a rally here, pause, and then another rally. And remember, there's a lot of fanboys and a lot of trading rooms, Musk fanboys and trading rooms that keep putting pressure on the stock. So it has this really nice volatility. It's still up and to the right, but it's jagged up, jagged down, jagged up, jagged down. And you need to use that to your advantage. Taking a look at innovative industrial properties. Honestly, I have not read the quarterly report, but this does look like a double bottom, doesn't it? So if you take a look at IIPR, something that people are asking about, take a look at the 1-year chart. Let's actually just, that does look like a double bottom. Teresa, what do you think about that? Is this your buy zone? I gotta imagine this is Teresa's buy zone. Yeah, man, it's going back. This really looks like a good spot. I mean, could it get down in here? I guess it could. So this is the last time they had a tenant that had a problem. They got down into the 50s. I mean, it could turn over one more time, get down into the 50s. Hard to know. I haven't read up. I do know that the tenant that is a problem is 17% of their rents. They're going to end up missing some of that. They already collected the security deposits, but then they defaulted a second time. They're going to have to replace most of this tenant. The tenant's going to hold on to some of their rentals, but it's not going to be 17%. It'll probably be like 6. Yeah, right. So they got to replace about 10% of their rents. And the thing is, their balance sheet is maybe the strongest of all the REITs. I mean, that's how strong their balance sheet is. They have a ridiculously strong balance sheet. And frankly, it wouldn't be hard for them to sell stuff. So is this the bottom in innovative? I don't know. But again, it's obviously a lot closer to the bottom than the top. And it does have a Wyckoff buy signal. So I think you could sell cash secured puts, but it's got such a big dividend. Why wouldn't you just buy the stock? And then when it gets up here into the 70s, decide what you want to do. All right. So I think you can make probably 10% here, which is pretty substantial for a short period of time, right? Between now and say July. But I don't know if they've addressed their tenant issue, right? I don't know if they've done that. I haven't read the report. So you need to read the report and see if you're satisfied with how they're dealing with the tenant issue. Bitcoin pullback. Well, I don't know. I think it's had a pretty good pullback, right? So it's going to rally for a little while. I have a hard time believing it breaks out to new highs. I think it's going to get in here somewhere and then come back. So can you trade it in the short term? Absolutely. If you are a superstar trader, have at it. I'm not bothering because ultimately I do still see it, down in here. I think the market cap shrinks. So you notice I look at it in terms of market cap. I think that the market cap is going to come back. Now, does it get all the way into this zone? No, I think it holds above this zone. So if you take a look at the price, right? If you switch it to price, see this zone here? I think it stays above that zone. It might have bottomed out here at 80-ish. I don't know. You can buy the dips if you really want to. Again, remember, I was buying under 20,000, right? We bottom tick this baby back in here. For me to be interested, I need to see it probably double bottom around 80 and then answer the question of, does it get all the way down here? I don't know. But I know that liquidity is going to get tighter and tighter and tighter over the course of the year. So I think these are last puffs on the current liquidity cigar, and you really should be thinking about the liquidity of the market because that debt that's coming due is huge. And Jerome Powell is not going to do quantitative easing this year. It's just not, unless we have a crisis. And if we have a crisis, you get much lower prices to buy, right? So be ready to buy a flash crisis or a flash crash. And that is what I'm going to leave you with. There is absolutely a risk of very quickly falling off a cliff at some point this year. Again, I think it looks a lot like 2018. Doesn't mean that it can't happen faster or slower. I think faster is more likely because we are going through liquidity fast, really, really fast. I've shown you other charts. You know, the debt chart that I showed you here, I might have closed it already, but I showed you that debt chart earlier. I think you're pretty safe to wait to get it around 80,000 again. The question I would really ask, though, is does it drop all the way down here into that 40 to 60 range? I don't think that's impossible. And in fact, if liquidity dries up, just remember, right? Pretty big corrections happen. What would that look like over here? It would be in here somewhere, right? Be in the 60s for sure. But it could be 50s or 40s. So, and honestly, like I said, if we get a recession, if we actually get a recession, numbers say maybe, you know what happens in recessions. The stock market will give back 30 to 50%, and so will all the other risk assets. Off air, I talked about maybe getting an office, but I'd rather buy real estate. And as good as of an office it was that I showed you, right, with Lake Michigan in the background, I think I'm going to get an opportunity to buy real estate. I think the next year or two, I think that there's a very good chance that we see major haircuts to commercial real estate, right? You have a lot of government real estate hitting the market. You have a lot of companies that just aren't going to be able to do much with, killing work from home. I think the hybrid thing, which is what I've said from day one in 2021, I think the hybrid thing is here to stay. It doesn't mean that you're going to work 4 days a week from home and 1 day at the office. I think it's going to be 2 or 3 days a week from the office for a lot of people. But that also means that it kind of becomes more shared space, you and somebody else sharing an office rather than just you in an office. I think it means that the cubicle is back. I'm already seeing that certain companies. So understand the changes that are going on in the economy. Understand that tariffs are bad for 80% of the population. Understand that mass deportations are probably bad for the GDP. There's just this transition period that they've talked about. It's not going to be easy. When have we ever had an easy transition, right? So, all right, I'm going to let you go. I will get this edited. I'll get the options income written today. As you can see, I wore a collared shirt and I shaved. So I do have to go out on an appointment, but I will get this done today. I have an article started that explains quantitative tightening and the potential for crowding out in the economy due to the debt. And I have to think of a working title because I have bazooka in the title now, but we're not ready for that. A few years ago, I talked about the Fed reloading its bazooka and cutting the quantitative tightening that they're going to do is part of that reloading. So the Fed is almost reloaded to fire quantitative easing again. I think it happens by next year, but I don't think it happens this year. And I think that we need to have a crisis to activate it. I don't think they do it without a crisis. So second half of the year, I think you get your crisis. Am I meeting people in Phoenix in April? I can. You have to come to me. I'm staying in Chandler near the Ocotillo, is it called Ocotillo? Golf course by Intel. I found a nice Holiday Inn. So if you want to come to me in the Chandler area, feel free. I don't think I'll be making it to Scottsdale. I'm going to hang out in Chandler and in Gilbert with her mom. We're going to a couple baseball games. If you want to come to the baseball game on Wednesday night, Orioles and Diamondbacks, I'll be there. So, you can meet for a beer somewhere in the stadium or outside. As far as Thursday goes, I probably can meet with people Thursday night, which is, what night is that? The 11th? The 10th. So Wednesday, April 9th, I'm at the Diamondbacks game, and on the 10th, I have nothing planned. So on the 10th, around dinner time and early evening, if you want to come out to Chandler, probably just come to my hotel, or we might go to we have a membership to what the heck, Cooper's Hawk. There's a Cooper's Hawk in Chandler, so we might go there. We have free wine, so I might as well drink it, right? I will be in Dallas in May from the 27th to the 31st. 27th, I get there at night, so no go on that. The 28th, we are doing Kennedy stuff because she hasn't been there before. And then the baseball game at night. Thursday, the 29th, during the day in Dallas. And then Saturday morning, I'm going to reserve for clients. I don't know if everybody's here. Where's my Gary's? My contingent of Gary's is not on the board today. So I have a trip because I'm going to Dallas for a wedding. So I'll have a few hours on the mornings of the 29th and 31st. And then I will be in Las Vegas June 15th to the 22nd, I think it is. So there's a couple of days in Vegas, be like the 16th, 17th, or 18th. That is when I will be there. So those are the 3 trips. I'll put them up. I'll be out east in August for a couple of weeks, probably about 10 days. If anybody wants to meet in Boston, I will be in Boston and then up in New Hampshire. If anybody vacations in New Hampshire, hey, I'll be near Lake Winnipesaukee in that area, the Center Harbor area. And then what else do we got? I don't have anything planned for the fall, and we probably won't do much traveling over the winter as we prepare to get married in March in France. All right, everybody, thank you very much. I will get this article written. Don't get FOMO. Just use these rallies as times to position. All right, take care.